Netflix just reported earnings and this stock is crashing. Is this an opportunity to buy the dip in Netflix stock? We'll talk about that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there. If you own Netflix stocks, you are having a terrible afternoon because just over the last year, the stock's up just 2.8%, but we're seeing in the after hours, this thing went from $508 per share. Oh my goodness, now we're down at about $408 per share. That is a $100 price drop on this one. That's about 18 or 19%. I have not seen a mega cap stock make this type of move in quite a while. Now, it's on the heels of reporting their full year and Q4 earnings, and the stock initially slid by 11%, but now we're seeing the stock closer down 20%. Oh my goodness, this is terrible, and we'll dive into the reasons why. We'll take a look at the user growth. We'll take a look at the average revenue per user. We'll take a look at the financials, not only the profit and loss statement, we'll look at the balance sheet and the cash flows over at Netflix. We'll also take a look at how the company grew their subscribers. In the most recent quarter, they added just 8.28 million net subscribers worldwide. Netflix's own expectations was for 8.5 million, and the street was at 8.32 million. So Netflix not only came underneath their own expectations, they came under Wall Street's expectations. That's part of the reason why this stock is heading downward. Now, for the full year, they added just 8.9% year-over-year growth on their global paid subscription to bring that to about 221 million paid members. Now, in the revenue grew just 16%. That's pretty slim to land at $7.71 billion. I'll show you that here in a moment when we get to the financials. But even worse, operating income fell by 34% as the company had to invest heavily into content, and that absolutely obliterated our operating income over at Netflix. We'll talk about that more here in a second. Now, earlier this week on January 14th, Netflix shares did jump by 3% as the company announced United States and Canada price increases, and so that had a positive impact on the stock. We'll talk about more of that in a second. Now, back in November, the company is one-dimensional, and this is one of the reasons why I've never bought Netflix shares. I've never been super bullish on this company because it is just incredibly one-dimensional, okay? And they've tried to branch out, bringing mobile games to iOS following an Android launch. This was back in November, but we've seen just over the last few weeks, okay, you had Microsoft make a $69 billion bid for Activision. You have Sony in this space. You have Apple in this space. You have a lot of great video game makers in this space. I, for some reason, don't believe that Netflix is going to bring a lot of value to this space and bring a lot of customers in this, and certainly as we saw that their expectations for subscribers came underneath what their own expectations were. Well, these video games are clearly not moving the needle over at Netflix, and quite frankly, competition in that space has more money and better titles than this company. I would have to expect them to invest heavily into video games if they ever want to make a dent in that market. Now, let's take a look at the regional breakdown. So what they do over at Netflix on their financials, they look at Canada, they look at Europe, Middle East and Africa, Latin America, and Asia Pacific. So the big market obviously is out here in the United States and Canada. We did see an acceleration in paid net additions. Those came in at this 1.19 million. Okay, that follows two successive quarters where it was basically flat or negative from a user growth perspective. In fact, this was the largest user growth for the United States and Canada in over a year over at Netflix. Now, what also grew was the fact that we grew our average revenue per membership. That went to $14.78. Now, this likely does not include this recent price increase. This was announced in January. These financials end in the end of December, so you'll actually see that price increase get passed on in subsequent quarters. Last year, we're sitting at $13.51. Now we're at $14.78. My guess is by the end of next year, you're probably closer to $15, maybe even $16 on this one. That is a positive for this company because as you see, user growth is starting to stall. In fact, it's coming underneath expectations that the company actually had for itself. And so one way to generate a little bit more money is to charge people more. And out here in the United States and Canada, I can tell you $14.78 for a Netflix membership is certainly still has some room to grow. They can increase the price on this, but at some point, they will reach a headwind with this price increase. They won't be able to pass that on, because then you could just switch to a Hulu, you could stick to Disney Plus, you could stick to traditional cable, some antenna ears, whatever it might be. At some point, Netflix will outprice themselves, so they will have to continue to innovate over at Netflix. Now, Europe, Middle East, and Africa, big business unit for Netflix. That came in really strong user growth. In fact, the strongest user growth we've seen since a year ago, came in at 3.5 million net adds on that. They also were able to pass on price increases, although it was down quarter over quarter by a penny. It was up year over year by about 59 cents per user. Latin America came in relatively strong user growth again, but again, these numbers are coming underneath what Netflix had planned already. So while they look pretty strong quarter over quarter, year over year, you see that we're still decelerating in this Q4. Also keep in mind this Q4, including an acceleration of the health situation. So theoretically, people were probably at home a little bit more and maybe more apt to having a Netflix membership. If this thing starts to clear up, people start to travel more, people get out more, people go to restaurants and those types of things. Well, maybe the Q4 is the best days behind Netflix. Investors might be thinking about that as well. Now, in terms of our average revenue per user for the Latin America region, that ticked up nicely, 14% year over year to $8.14. In Asia Pacific, very strong user growth again, the strongest that we have on record. In fact, two subsequent quarters where we did over 2 million net adds, 2.58 million in the most recent quarter. But unfortunately, our average revenue per user is down. It's down to $9.26. Last year we were at $9.32. Previous quarter you were at $9.60. So we have that price increase ability here in the United States and Canada. That is not going to be the case across the world. Okay, different economic situations in other parts of the world. Also, the content available to be consumed might not be worth it. Whereas out here in the United States and Canada, you've just got a plethora of content that you can view over at Netflix. Now, let's take a look at these financials. I think these are what investors are really digesting when a stock makes this big of a move. It's not always just kind of the headline stuff. The 8 million subscribers coming in underneath expectations, the guidance that came in a little bit weak. Real investors are looking at this stuff, okay? And so we see our revenues came in at the $7.71 billion. Last quarter, we were sitting at about 7.5-ish. Last year, you were sitting at about 6.6. So again, relatively meager growth year over year, just 16%. But what is growing absolutely bonkers is this cost of revenues. Take a look at that. That came in at $5.2 billion. So off $7.7 billion worth of revenue, you had to spend $5.2 billion on that cost. This is not a high margin business. This is not a Microsoft. This is not a Google. This is not a Facebook. This is not really even Apple. It's much more closer to akin to an Amazon. And so this is not a high margin business. And this is why we kicked it out of the FANG Stock Recap show, to be honest with you, because this is just not acting like a tech stock. Take a look over the last year. You went from 4.1 billion in product costs all the way up to 5.2. And you're like, well, that's a lot. Okay. Over the last year, look at just quarter over quarter. You went from 4.2 up to 5.2, an extra $1 billion. Yeah. An extra $1 billion on that cost side. Marketing went up to 800, technology and development up to close to 650 million, general administrative up to about 400 million. These are all accelerating, as you'd expect to a certain degree, year over year. But what it accelerated the most was this cost of revenues went up $1.1 billion in just a year, and your revenues barely moved. Okay. They went up by basically the same amount. And so that is a bad sign. This company is actually not scaling up nicely. Take a look at our operating income. Boom, down to 631 million. Where were you a year ago? On $6.6 billion worth of revenues, you were at 954 million in operating income. Now you have $1.1 billion more in revenue to 7.7 billion. But look what happened to our operating income. It went down by like 300 million bucks, down to $631 million. Look where you were a previous quarter. You were at 1.7 billion in operating income. That got more than cut in half in the most recent quarter. Absolute disaster over at Netflix. There's a reason why the stock is down big. Now, you get some interest income, you pay some interest expense, you pay some taxes, you come down here to net income. Ooh, this is really bad. $607 million worth of net income off of $7.7 billion. That's less than 10% operating income or net operating incomes. That is really, really bad. That is not tech-like. That is not Apple-like. Apple's are closer to 30%. You look at a Google, you look at Facebook, you look at NVIDIA, you look at all these companies, they're way, way higher than this. The only company in the FANG realm that is close to this is an Amazon, but we also know that the company is investing heavily for the future. And you could make that argument to a certain degree with Netflix. Earned only $1.33 diluted. Last quarter, you're at $3.19. Last year, you're at $1.19. Really, really disastrous quarter for Netflix from an operating income perspective. From a balance sheet perspective, we burned through some cash, okay? We got about $8 billion. Last year, we were sitting at 9.7, but you did invest a lot of that into these content assets. Notice you went from 25 billion in content assets, nearly 31 billion at the current time. That gets you total assets up from 40 billion up to this 44 billion. So at least they didn't blow this money on stuff that really isn't going to be able to monetize. They're going to be able to monetize these content assets, but it's just showing you this company is like literally on a treadmill, kind of a hamster wheel business where they constantly have to throw money at this company and these content in order to maintain their subscribers. They spent more on content this year than any other year on record, and we saw mediocre user growth. So this company is going to have to do something else in order to attract new users to this service, in my opinion, or maybe create a different business model. Instead of charging users a subscription fee, maybe start doing an advertised supported model, much like we see over at Roku and Hulu as well. The company does have quite a bit of long-term debt, $14.6 billion. I tell you what, when we take a look at cash flows and how they turn negative, that could impact this at some time as well. You notice that we went from 15.8 down to 14.7 on that long-term debt, but notice we went up by about 200 million on that short-term debt. So some of that just basically got rolled over to that. Now, probably what investors are really looking at here and are extraordinarily disappointed at is we've got our cash flows. Here's our 3 months ended here. Right here, we pull down that disastrous net income number of just 607 million. We get to add back in our content cost. Okay, you get to do that on cash flows because this is something that you monetize over a long period of time. You get to add back and subtract some other things, and you get down here to net cash provided by operating activities. Look at that. Terrible. Lost $403 million in the most recent quarter. You see, for the full year, look at this. Look how bad this went for Netflix. You went from positive cash flows last year of $2.4 billion down to 392. Dare I say it? Could Netflix be one of these pandemic darling stocks? Like a Teladoc, like a Peloton, like a Zoom Video? Could this stock end up being like those where it just gets absolutely decimated in the coming weeks ahead because people look at this as 2020 was the best year it was ever going to have, and everything after that is going to be really, really bad, okay? Now, everything else from a cash flow perspective looks typically normal with what we've got. This company is burning through a fair amount of cash, and if these quarters continue, they're going to have to do some kind of equity raise, some kind of debt raise at some point. $8 billion just isn't going to cut it when you've got competition right down your throats over at Netflix. Now, speaking of down and down through your throat, oh my goodness, take a look at this. I had this red line in here, this level of support at about $460 per share on Netflix has held for a long time. Since June of last year, that's when this support was in there. This stock, when it got above 579, in my opinion, kind of created a selling opportunity. It wasn't surprising that this stock came all the way to 700 and then looped all the way back into this sideways consolidation. Not really something I would have been concerned about, but once you broke through 460 on this one, look out below. And then we actually took down what were the previous highs back here. These were back in July of 2018. We sliced through those. Those were about $425 per share. Stock's currently sitting at about $420 per share. I'm going to change this to a red line because if you break through this red line right here at about $380 per share, which is literally just $20 or $30 lower than where the stock is right now, oh my goodness, look out below. You're coming well south of probably about 350 on Netflix. It looks really bad. These red lines, I'm going to change this one back to a green line, because what I want you to visualize here with these green lines, they should act as some level of support. You do see the stock kind of stall, and this line might not be drawn in here perfectly, but you see the stock stalling where this green line is. It should, if it continues to walk down, should find some support down here at 385. But unfortunately, this red line, which was a key area of support, once you slice through that, now this is going to be a key area of resistance, and it's going to be very hard for this stock to get back over and above the 465 level. I would not want to touch Netflix until we see a sign of a reversal. What is a sign of a reversal? It is higher lows. Take a look at this. Back in July to September of 2019, the stock went from 382 all the way down to about 256, but then it started making higher lows. And you're saying, well, I want to pick it at the bottom. You didn't have to. Look at this stock. It went from 255, even if you were really late, got up here at about 300. It went from 300 all the way up to almost $600 per share in just a couple of months. So you don't have to try to pick the bottoms on these ones, try to pick the perfect opportunity. Wait until you start creating these higher lows like you did all along here, okay? Same thing here. The stock took a major dump like most stocks did back in March, but then it created a series of higher lows all the way up, okay? Now that's what you're waiting for on some kind of bounce with Netflix. This is if you want to buy the dip on this one. I personally probably wouldn't. So you're looking for just a series of higher lows. At some point, we hit a level of support and the stock starts inching back. Me personally, I really wouldn't get excited about this stock until you got above this previous area of major support for this stock. Literally over a year, this stock had support at 467. It broke through that. I wouldn't get excited until you put some candles up above that. You put some candles up above that, I think you could go to 470, back up to 580 on this one, but it's not going to come easy. The story has changed over at Netflix. It's starting to remind me a little bit more like a Teladoc Health, a Zoom Video, a Peloton. Whether or not it continues to go down like those stocks, we'll find out in the near future. But right now, from a fundamental perspective, this stock is not printing positive cash flows. It's printing lower and lower operating incomes, and it is showing you that competition is fierce in the streaming market. The fact that they spent over $1 billion over the last quarter and over the last year on content, and it didn't even help subscriber growth beat the company's expectations. I personally would steer clear of Netflix. Hopefully you guys enjoyed this video. I'll be back again soon with more. Good luck with your investments.